Well, hello again. Mike Gooden with Reduced Risk Retirement Solutions here, where, of course, we are certified financial fiduciary with 20 years of experience helping people keep their money, grow their money, pass their money to their heirs. In this video, we are going to talk about long-term care protections. It is a very real thing that we need to think about. And there's fortunately, I'd say in about the past decade, there's been a lot of change in the types of plans that are available, changes for the better. So we're going to get into all of that. We're going to talk all about long-term care, why it might be a good idea to have some long-term care protection in place. The first reason is the 70% rule, probability versus perception. The reality is that 70% of people over age 65 in the United States will require some form of long-term care services during their lives. And there is a little bit of a gender gap here as well. Women generally need care longer, average 3.7 years, than men, 2.2 years. That actually was panned out with my parents. My mom was in long-term care for 2.5 years. My dad never got into long-term care. And the age myth, it is not just for the elderly. Approximately 40% of people receiving long-term care today are between the ages of 18 and 64. And that's often due to accidents or chronic illnesses. I think it's also important to note that with the way premiums are calculated on some of the long-term care plans available, really kind of the sweet spot for starting a long-term care plan that you're going to pay premiums into is about age 55 to 60. For a couple reasons. Number one, they are very, very strictly medically underwritten. So you got to be very, very healthy with a good family history to even qualify for those plans. But number two, that will generally keep your premiums down lower over time because you started contributing to your plan earlier. And then we gotta make sure that people know, number two, Medicare is not a safety net. There is very, very little help available through Medicare for any kind of long-term care. Um, Medicare only covers skilled nursing care, rehab for a short period following a hospital stay. So it does not cover custodial care, help with daily activities like bathing, dressing, eating, etc. And then there's also constraints with qualifying for Medicaid or Medi-Cal, as we call it in California. In order to qualify for Medicaid and have Medicaid pay for long-term care, you've got to do this real vicious spend down of all your assets until you're basically at poverty levels because you can't qualify for Medicaid until you're at near poverty levels. Fortunately, these days, as of I think about 10 years ago, they will let a surviving spouse or the spouse that is not in care keep the primary residence. It used to be like 15 years ago they'd have to sell the house to pay for long-term care and then qualify for Medicaid. So that's at least a small improvement. Um, another thing that is important for a lot of folks is to preserve their choice and their independence. Long-term care insurance isn't just about paying for a nursing home, it's about staying out of one. Uh, home care. Most modern policies allow you to use benefits for in-home caregivers, home health care, which is where the vast majority of people prefer to receive care, which helps them maintain a quality of life. Without insurance, your options are limited to what you can afford out of pocket or what Medicaid-approved facilities have available. Insurance gives you the first-class ticket to the facility or home care agency of your choice. It reduces the burden on your family. Many people assume their children or spouse will care for them. And while well-intentioned, the reality is often different. And when I get into later in the presentation, my personal experience in caring for my mom before she went to long-term care. Uh, because it does take a physical and emotional toll on the family caregivers. It's often a full-time job that leads to burnout and health issues for the caregiver. And then, of course, there can be a financial impact on the children. Many adult children have to reduce work hours or quit jobs to provide care, impacting their own retirement readiness. And insurance allows family to be family and not unpaid medical staff. That was definitely part of my experience. Oops. And number five, protecting the healthy spouse. As I said, long-term care costs can be a wealth-destroying event, um, with nursing home costs often exceeding 100 to $125,000 per year. A few years of care can wipe out a lifetime of retirement savings. So, in order to retain some financial security for the healthy spouse. The insurance ensures that if one's spouse needs care, the other isn't left in financial ruin trying to pay for it, preserving the couple's standard of living. Again, Medicaid and Medi-Cal do not help with long-term care costs until one has depleted their assets to a near poverty level. Fortunately, a surviving spouse or family member can still keep a primary residence, like I said. But as of 2024, cash on hand and liquid bank accounts are no longer counted, which is nice, but any income generating accounts are counted and have to be spent down. And there's a 2-year look back of actually 30 months that Medicaid and Medi-Cal will look back. And so if you're applying for long-term care services, you might be required to provide asset verification if within the past 30 months assets were transferred for an amount less than the fair market value. So that's what they're going to do. They're going to dig into your finances. And if you gave an income generating account to another family member or something like that, they're going to find it. They're not going to be happy about that, and you will not qualify for Medicaid and Medi-Cal assistance. Costs are exorbitant. The annual median cost for nursing home private room is $136,948 a year, 11,412 bucks a month. For a semi-private room where you have one or two or possibly three roommates, you're still looking at $119,340 a year, almost 10 grand a month. And then assisted living, a little bit different than nursing home, as it will. Assisted living is slightly lower level of care. Still $75,000 a year. Home health aid, a full-time home health care. I think this is low, quite frankly. I mean, this is from Google, of course, our Oracle Google. But in my experience, when I was caring for my mom in using home health care, a full-time home health care aide would have cost us, if it was 7 days a week, would have cost us just as much as a private room in the nursing home that my mom ended up being. So again, I think this is fairly low, quite honestly. And then adult day health care, where they probably get picked up by a transportation service and taken to a little day camp for seniors. They're great places. They're great places, but even those aren't cheap. 27 grand a year. It should be noted. I wish I didn't have experience with this, but the difference between the Medicaid approved facility that my artist aunt ended up spending about a year and a half in, and the difference between the facility that my mom uh, stayed in for $11,500 a month for 2 years was night and day. I mean, my Aunt Mary was in a room with three other people in hospital beds, and my mom had a private room all to herself. And so, to avoid the spend down and afford a facility which provides for a better standard of living and care, long-term care funding is essential. In the US market as of 2026, fortunately, long-term care coverage is no longer a one-size-fits-all proposition or product. This industry has shifted significantly toward linked or hybrid products that address the common fear of paying for insurance and never using it. So we're going to go through the three main types of long-term care insurance that are available here. And the first is just a traditional standalone long-term care insurance plan. This is what my parents had because back in 19, oh, it must have been 2000 when they got a long-term care plan. This was pretty much the only thing available was a standard long-term care plan where they're paying monthly or annual premiums into it, and they get a pool of funds that those premiums pay for to pay for the long-term care when it is needed. So the way it works, like I said, you pay a monthly or annual premium for a specific pool of benefits that is then used to pay for the long-term care until it is exhausted. My parents had a $250,000 benefit that would be split between both of them. So the pros is that it has usually the lowest initial premium, and they're generally quite customizable. You choose the inflation protection and waiting period, what we call the exclusion period, which I'll get into. And then the cons is, as I said, it's use it or lose it. If you pay all these premiums for years and years and years into the plan, and then neither of you go into long-term care, then you don't get any money back. So it's a use it or lose it proposition. There are also state partnership programs in a lot of states that have a partnership between private insurers, long-term care insurers, and Medicaid. And so how these work is that if you buy a partnership qualified policy and eventually exhaust your private benefits, like you spend all of that $250,000 that you purchase through your monthly premiums, then when you move to Medicaid and Medi-Cal, uh, they're going to let you keep $250,000 in income generating accounts that would normally have to have been spent down to zero. So a little bit confusing there, but the pros, it provides a safety net for the safety net. So you get the $250,000 benefit for the long-term care, and then if that exhausts, you don't have to spend 200. You can keep $250,000 of income generating assets and still qualify for Medicaid. And then number three are the fastest growing and most popular choice, and it is hybrid linked benefit plans. So these combine long-term care with life insurance or an annuity. And how it works, if you need care, the policy pays for it. If you die without needing care, your heirs receive a death benefit. That's in a life insurance-based policy, or the amount of the initial investment on an annuity-based policy. And in both of them, if you change your mind, some of them offer a return of premium feature. So your principal investment is protected. If you change your mind, they're going to give you back the premium that you've paid into it. So it is protected. It will be returned to your state. And if you do not need the long-term care or decide to cancel it, the funds will be returned to your estate. So the pros premiums are usually guaranteed. They don't go up. That's in a life insurance based policy. And you're certain to receive a benefit. Either you're going to get your long-term care paid for, or it's going to go as an inheritance to your heirs. The cons are there's a higher upfront cost. Many people fund these with a single lump sum. That would be more of an annuity-based long-term care policy. And the way the annuity-based long-term care policies work is that you put, say, $100,000 into it, and they're going to multiply that often by 2 or 3 times. So you start with a pool of two, three, or $400. Some companies are even multiplying it by 400,000 these days. And so you start with that pool of $400,000. As you spend that down for your long-term care, if you pass away and there's still $100,000 left in that account, that $100,000 will be returned to the estate. It will go to your heirs. It is important to note that the traditional, the partnership, and life insurance hybrid LTC plans have stringent medical underwriting. The extent to which an LTC insurer will look into your medical history cannot be underestimated. If you are anything other than grade AAA healthy, healthy as can be, you will likely not qualify for one of those plans. Again, family example here. My father finally agreed to get themselves LTC coverage when my mom was 65. So yes, indeed, that was in 2000, no, yeah, 1995. So they applied and began the underwriting process, which actually took several months. Fortunately, this was before my dad had any melanoma diagnosis and my mom had any macular degeneration diagnosis. So they did qualify and got the plan. But I kid you not, literally the month after they qualified, my mom was diagnosed with that macular degeneration. If that diagnosis had come a month early, she would not have qualified. She would have been denied for any plan available then, back in 1995. A hybrid annuity long-term care plans usually do not have medical underwriting because you're given the company a big lump sum payment up front. And that is your money. You still own that money. The company is only borrowing it. And so they take that investment and then it's multiplied these days by 3 times or even quadrupled to fund the benefit pool. And then any unused funds of the original investment, like I said, it is returned to the decedent's estate upon passing. So if a couple puts 100K into a LTC annuity, they will have 300,000 to 400,000 pool of funds to pay for long-term care. If neither of them needs long-term care before they pass, the 100,000 is returned to their estate. If they use, you know, 300,000, if they've got $300,000 in their pool of funds and they only use 200,000 of it for long-term care, then still that $100,000 will be returned to their estate. Activities of daily living are important to know about because they generally trigger your long-term care benefits, and exclusion periods are even more important to know about. So here's how they work. 9 times out of 10, the inability to perform 2 of the activities of daily living listed below will trigger the benefits and exclusion period, if there is one, in an LTC plan. So the 6 core activities of daily living are bathing, dressing, eating, transferring the ability to move into and out of a bed, chair, or wheelchair, toileting, and continence. So any two of those, and that's going to trigger the long-term care plan. It was a big chore with my mom to convince her, okay, when we go see the licensed healthcare practitioner to certify that you can't do two ADLs, it's human nature, especially when we get older, to say, oh no, I can do this. I can do this. I can get up out of this chair and walk across the room and get into bed. No, I can feed myself. I can. It's human nature to not want to reveal weakness, and it's human nature to want to convince people that you can do things for yourselves. But boy, I tell you, the one time that you don't want to do that is when you are being assessed for ability to do activities of daily living, and you're hoping that your long-term care plan is going to start paying for some of your care. Upon diagnosis by a licensed medical practitioner that a beneficiary cannot perform two or more ADLs with standard and partnership plans, the exclusion period begins, and that is on anywhere from a 30 to 180 day period during which benefits are not paid after being diagnosed as not being able to perform two ADL. So again, in my mom's case, they had a standard plan and she got diagnosed as not being able to perform several ADLs when we went in for the assessment. We still had to wait 90 days. She had a 90-day exclusion period before the plan would start paying benefits. Shorter exclusion periods are available, but of course, they'll generally have a higher premium than a longer exclusion period. Some hybrid plans allow a person to access their accumulated LTC funds immediately upon not being able to perform two ADLs. And there's a balance between the length of exclusion period and the corresponding costs, premiums that needs to be examined. So obviously the goal is to have the shortest exclusion period one can afford. So I'm going to conclude what we've talked about here for some needs and how it works before I get into a couple real world examples in my experience with it. You know, again, 70% of the population is going to require some sort of long-term care. Medicare and Medicaid, Medi-Cal provide very little to no assistance with the very high cost of long-term care, leaving the financial responsibility for it to you and me and us. In order to avoid a spend down, a draining of one's income generating assets, one needs some sort of coverage to cover the costs of long-term care. Fortunately, there are multiple ways to address the cost of long-term care these days, and with some options returning any unused funds to the beneficiaries' estates. Reduced risk to job is to explore all viable options for long-term care for each individual client with a focus on retaining assets for their family and estate. And to structure a long-term care with the primary focus that our clients keep their money, grow their money, and pass it to their heirs. So a little real world case study here. We've got Mr. Pink and Mrs. Green again. They both lost the ability to perform two activities of daily living. Mr. Pink is self-funding, and Mrs. Green has a long-term care plan. And their nursing home cost $120,000 a year. So for a full 3-year event, Mr. Pink would pull $360,000 out of his pocket to pay for that nursing home, whereas Mrs. Green only pulled $45,000 out of her pocket to pay for the 90-day elimination period. And then after Mr. Pink spends the $360,000, if he's still in nursing home care, he's going to have to spend down and liquidate assets until he's pretty much at zero and has no income generating assets. And then Medicaid might help out. So, I mean, imagine if he equally sells $360,000 in stocks and bonds, he's also going to pay a load of taxes on that. So that $360,000 really isn't $360,000. It's far less than that because there's going to be a lot of taxes to pay on that, capital gains taxes, income taxes. Whereas Mrs. Green, her portfolio remains untouched and there's no tax impact because insurance benefits, all the benefits that her plan is paying out are paid out tax free. So, in a similar estate, Mr. Pink would be down to $1,140,000, down 24%. And Mrs. Green is only down to $1,455,000. She's only down 3%. And, there's probably a family burden here for Mr. Pink. Children probably managing the finances and care. Whereas on a good LTC plan, you're going to have a core care coordinator that manages all the care and finances. My personal experience, I'll get through it as quickly as possible here. My folks had a traditional long-term care plan when they're of age to get something. The hybrid plans didn't exist back in 1995. So my father died without needing any long-term care. So he paid a bunch of premiums into the plan, but he never got any benefit of it. My legally blind mom, suffering from mild dementia, wanted to move into our attached granny unit after my dad passed away. Which is what we wanted. We asked her, "Do you want to stay here at the active adults community that you're at, or would you prefer to move in right next door to us?" Where you can have your dog and have a dog door and things like that. And she's like, "Oh, please, please let me move into your apartment," which we did. And within about 3 months, I certainly had to reduce my work hours to provide care for her. And 1 year in, she suffered a dramatic decline due to urinary tract infection, a UTI. This is my public service announcement for anybody over about the age of 65. Good grief. I did not know this until it happened, but monitor and take care of your urinary tract health. When people get urinary tract infections in their later years, it can bring on dementia like hitting a brick wall. I kid you not. I went and checked on my mom. She never woke up until 11 a.m. When she was here with us in our granny unit. So I went to check up on her 11:30, see if she was getting her oatmeal and her oatmeal or her granola and walnuts, whatever she liked to eat. And she was fine. She was up doing her stuff. And 5:30 in the afternoon rolled around. I look outside and my mom is wandering around in front driveway. I told you she's legally blind. At this point, she was quite blind. I go out and I go, "Mom, well, how you doing, Mom?" She's like, "I don't know. Where am I?" She was completely panic stricken, didn't know where she was. And it was just this incredible change just in 6 hours. And so, we got her into the doctor real quick. We got her checked for the UTI. Sometimes after they give you antibiotics and get the UTI cleared up, you will kind of go back to normal. That was not my mom's case. And so, she realized she had enough of her faculties to realize that she did not want to burden my wife and I with the high level of care that she was going to need. And quite honestly, I don't even know if we are qualified to give her that level of care. And home healthcare was not really a viable option as she really needed supervision and assistance for more hours in a day than home healthcare would afford. Generally, they're only going to come for 8 to 10 hours a day. And like I said, it's going to be every bit as much, at least here in California, as going to a very nice, what we would call assisted living with nursing care facility available. So we did get my mom into what is considered one of the very best, essentially assisted living slash nursing home places here where we live. And she spent 2 years there in a private room, a very nice facility, but it was $11,500 a month. She received very good care and nutrition and meals and attention, and her long-term care paid for all months except the first three, that 90-day exclusion period. Of a total cost of $241,500 was paid by the long-term care plan. As the pool of funds that their years of paying premiums had purchased was $250,000. The remaining 8,500, however, was not returned to their estate. But I want to note that if my father had not passed away before needing long-term care and had needed some long-term care, the costs of his long-term care would have been extracted from that $250,000 pool of funds. And so there might not have been enough to pay for all of the 2 years that my mom needed care. And if that was a traditional plan, again, none of the unused benefit was returned to the estate after my mother passed. But I want to, just hit it home. Without that long-term care plan in place for my mother, the entire cost of her long-term care stay would have been paid out of pocket from her retirement accounts until she reached poverty level to qualify for Medicaid. And after qualifying for Medicaid, she would not be allowed to stay in the facility that she was at. They would have moved her to a Medicaid approved facility, similar to the one my aunt was in. She would not have a private room. She would have not nearly the quality of life and quality of care, quite frankly, that she did have. Because I mean, what do you think? Do you think Medicare approved long-term care facilities are particularly grand or luxurious in any way? Again, reduced risk. We are an independent broker. We are not employed or allegiant to any one or any particular insurance company. We work for you, our clients, in a fiduciary manner and not any insurance company. Our job is to find the right long-term care coverage for your specific situation, circumstances, and goals. And finally, we act as an advocate on our client's behalf. If the insurance carrier is not holding up their end of the bargain, we deal with them on our client's behalf.